Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
The biggest mistake people make, and this goes back to technology and Facebook, etc., is thinking every trade they're going to go in is going to be a 10-bagger. Now, I'm on a couple of these share trading groups on Facebook, etc., and everyone just bangs on about 10-baggers. Oh, when's my next 10-bagger? Well, reality is if you got one 10-bagger in your lifetime, I think you've done well. If I invest in a stock and I could beat bank interest, then I think I've done well. You know, you put your money in the bank at the moment, you can say 4 or 4.7%. Well, if you can get a 10% return out of the stock you invested in, then you're, 5 and a bit, 6% better off. So I think that's what you should be looking for, and not just these 10-baggers and these stories of these people who are lucky enough, and it is luck, that they've invested in something and it's gone through the roof.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. How can you directly support your favourite charity and trade shares at the same time? Today we're looking at Australia's first ever share trading platform dedicated to raising money for worthy causes. G'day, Alistair.
G'day, Phil, and thank you for having me.
Thanks for coming on. Can I call you Al? I notice that you say your name Al everywhere, so Al. Alistair Warren has had a professional career in finance and stockbroking for over 30 years. He spent much of that time at some of Australia's leading stockbroking firms, including Macintosh Securities and Merrill Lynch, in senior management roles. And of course, now you've started your own business. How's that going?
It's going well. It's been we started during COVID, so it's been a tough time to start a business. And the markets certainly of late haven't been very helpful for us, but it's a very rewarding business, Phil. When you're dealing with charities and donating money, it's a rewarding end of the month.
So talk to us about the difference between broking when you first started to now. Obviously, there's a huge amount of differences. Yeah. Listeners will know I love hearing old war stories.
Oh, I could tell you some. Yeah, so while I started in 1987, as you mentioned, with Macintosh Securities, they were probably one of Melbourne, Australia's most prominent brokers back then. I came straight out of school, went into stockbroking as a messenger, and that was, basically running up and down Collins Street all day to the trading floor, doing settlements, taking big baskets of scrip and getting checks, etc. Massive learning curve and such a fun environment, hardworking, but fun environment. So, the big difference is clearly technology. As I said back then, when I started, you had the trading floor and you had chalkies scribbling prices and doing trades that way. The tickets from the trading floor, you had to manually punch into the computer. The settlements, as I said, was all manual. You had the old share certificate and transfer forms, and you had to match the two together and send them off down to the custodians, etc. So technology has played a massive part in the change in the last 36 years, for sure.
Do you think fundamentally it's any different, though? Really, it's still a market, isn't it?
Yeah, no, 100%. You can only buy and sell shares, one way, right? Buy or sell. I think fundamentally, the only sort of change, I guess, would be speed of trading. Now that we're all on computer and it's all computerized, and now you've got algorithms, and we're moving into AI trading as well. That has changed. It's harder, I know a few guys who are professional traders, and trading against the machines has made it very, very hard over the years. But fundamentally, you're 100% right. You buy sells or you sell shares.
Do you think all the changes have been good for investors?
Yeah, I do, actually. I think the internet has certainly opened up a wealth of information to investors, and especially, as your podcast is for beginners, there's a lot of education out there, free education, research, how do I, research a company, or how do I, educate myself on buying and selling shares or investing. So I think technology has been a good enhancement to the business. It's improved efficiencies, again, back in the 80s, we used to call it, you trade on the never. So you'd buy shares, and if it went up, you'd pay for them. If they didn't, or you just sell them and never pay for them. And if they didn't go up, well, you would just send your check whenever you did. But of course, then we moved from that T+5 settlement, and now we're at T+2 settlement. So, efficiency, it certainly has been good.
And of course, I got to commend you guys on the education that you provide. I follow you on Twitter, and you give some really good information about what investors need to know about buying and selling shares.
Yeah, that's Ben. That's my business partner. Ben's background, he and I have worked together for a long time prior to starting Trade for Good. And he's spent probably the last 15 years supporting retail investors from a technology point of view, how to trade, fundamentals, setting up alerts, etc., that sort of stuff. So he's very driven by education. He loves providing that information. And that's, we've got a balance with our social media and LinkedIn posts between trading, education, and obviously our charity work. So, what are the charities doing? How does trading benefit them? So, it's a big part of what we do. And as I said, Ben does a terrific job.
Yeah, I've got to commend it. And, Trade for Good on Twitter. And it's LinkedIn as well that those posts go? Is that the
we've got
platforms?
Yeah, that's right, Phil. We've got the full suite. So we do LinkedIn, Twitter, Facebook, and Instagram.
Do you have any sort of information on the kind of investors that come to Trade for Good? And are there new investors there, do you think?
Yeah, 100%. I think it's interesting. I mean, without sounding silly and putting it too simply, we can trade with anyone who trades shares. So that's from experienced retail investors, and we've got a number of professional traders, guys and girls who sit at home and actually that's how they make an income, through to new investors. Got sort of I don't know what we're at to, millennial or Gen Zs, who certainly like the philanthropic side of what we do. We have a number of financial advisors who trade through us, so that's sort of the wealth managers. We have platforms. We're just integrating to a new platform that's coming out called Advisor Universe. We've just been put on NetWealth's approved panel list. We have institutional clients like Pitcher Partners and Armitage, which is a fund in Melbourne. And interestingly, we've just partnered with a long-short manager out of Melbourne called Westbourne Asset Management, run by a really, really terrific guy called Charlie Burgess. His fund's sort of been closed, just sort of managed his own money plus some sophisticated investors' money. But he was trading through us, loved the philanthropic approach, and he's actually now going to turn his fund into more of a philanthropic fund where he will donate a minimum of 1% NTA, which is net tangible assets or the value of the fund, every year to a partner charity.
That's great. So if you were to talk to a new investor, is there something that you would, or one thing that you would have top in mind to tell them to be careful of?
Yeah. Well, I've actually got 3 things, Phil.
I
hope that's
prepared.
all right.
You've prepared. That's great. No.
Well, I think it's important. I think the one major thing I think is, for new investors is understand the company you want to invest in. Understand the fundamentals, the balance sheet, what it does, what it actually does. So get to know the company that you think you're going to invest in. And I think the biggest mistake people make, and this goes back to, technology and Facebook, etc., is thinking every trade they're going to go in is going to be a 10-bagger. Now, I'm on a couple of these share trading groups on Facebook, etc., and everyone just bangs on about 10-baggers. Oh, when's my next 10-bagger? Well, reality is if you got one 10-bagger in your lifetime, I think you've done well. If I invest in a stock and I could beat bank interest, then I think I've done well. You put your money in the bank at the moment, you're getting, say, 4 or 4.7%. Well, if you can get a 10% return out of the stock you invested in, then you're, 5 and a bit, 6% better off. So I think that's what you should be looking for, and not just these 10-baggers and these stories of these people who are lucky enough, and it is luck, that they've invested in something and it's gone through the roof.
I think it's always interesting, that idea of a 10-bagger is, it's if you're not experienced and you see suddenly your stock soaring and skyrocketing, there's a temptation to sell at 10%, 20%, 25%, and most people sell before it even becomes a 10-bagger.
You're 100% right. It's yes, 100%.
Because you're playing that psychological game as well, aren't
correct. You? Yeah, I mean, you've got to have nerves of steel, right? Who wouldn't want to take a 10, 20% return, 25% return? I think some of the classic ones, obviously the big one was GameStop in America. More locally we had Zip, that went from zero to hero and is back at zero, basically. Well, not zero, but a long way off $11. But, the reality is those people who held it from, say, 50 cents to $11 would be none. Because you just wouldn't. You might buy and sell it through the course of as it rises, but reality is you're not going to hold it from 50 cents to $11.
And the reality is, in the Australian share market, dividends pay play such a huge role in terms of returns, don't they?
Yeah, 100%. Getting a dividend yield for building your wealth is critically important. It's finding those stocks, and we've got a number of fundamental tools and analysis tools now and our system that allows you to do that. But yeah, dividends, and also, a good way of doing it as you're building your wealth is dividend reinvestment plans. So instead of getting a check for $35 from Telstra, you select DRP, which you do through the share registry, and that'll invest back into the physical shares. So you might get an allocation of 15 new Telstra shares. Better that, you're going to get a check for $35 and just waste that. But this allows you to then go, well, okay, well, I got an extra 22. So then it's compounding. I think that's a very good way for a new investor to build a good quality and portfolio.
Yep, rather than dreaming of those 10 baggers.
Correct.
Once they get on the forum and then start saying, okay, this is where I'm going to make my fortune,
Yes, exactly.
Yeah, right.
Yeah.
So what inspired you to co-found, I'm saying co-found because you are a co-founder, what inspired you to co-found Trade for Good?
Look, I think there's two answers to that question. One is, if you think of what we do and we just take brokerage less our execution and clearing costs and, divided by 2 or donate 50%. And that's a standard model in broking. If I work at Shaw and Partners or I work at Morgan Stanley, I pay the house or the company, probably anywhere from 50 to 70% of what I write. But that model is not usually applied to the self-directed market. So like the Comsex, NAB Trade, CMC, because there's no advice. So there's no need to pay the house those percentages. So common model, just applying it to the self-directed market. We don't provide any financial advice. It's what they call non-advice execution only. So we provide you with the tools to trade. You make the decision when to buy and sell, and that's how you do it. So there's that side of it. And if I'm honest with myself, I think post GFC, I having been in the industry for 36 years now, I was pretty disappointed with us as an industry. And probably more so Wall Street, to be honest, just through the pure greed. You had big firms over there, and I probably won't mention one. I don't particularly want to get sued, but, they were, and there's been certainly a Hollywood movie made about it, but, you had big firms shorting it, which means you sell it at a high price on the hope that you buy it back at a cheaper price. So reverse to a standard investment strategy, shorting it on their book but selling it to their retail clients or their investors. And that, I thought, we're a pretty poor industry when we're all about us and it's all about greed. So I thought, this is a good way of potentially making something that is a bit of a legacy, something that can give charities a consistent return. That's what all the charities strive for and struggle with, is having a consistent level of donation or revenue, which allows them to, plan and grow and implement, strategies to their specific philanthropic needs.
So, Al, speaking of these charities, which are the ones that you support?
Yeah, when I started it, I had 30 in my mind, Phil, and I don't know why. I thought 10 for humans, 10 for animals, and 10 for the environment. But reality is, in Australia, there is 58,000 registered charities, which grows at about 4% a year. And I think they're the second largest employer behind hospitality. So
really? I had no idea about that. Yeah.
Yeah, no, it's a big industry. And, I've learned a lot about charities over the last 3 years. Yeah, it's an interesting space. So we started with that 30, but reality is humans need so much more support, whether that's medical research or whether that's, housing, domestic violence, food. Food Bank is one of our big charities, and the amount of work that they do with, providing meals, and the amount of need for that is quite staggering. And I think that's, it's well publicized on news and everywhere that, that's increased through, cost of living pressures. So I think, if we get to 30, we've currently got 15, or we've got 16. We have Trade for Good's choice. A lot of our institutional clients just say, leave it up to you. You guys sort it out at the end of the month, and we just pro-rata across everybody. But if we got to 30, I think it'd be 20 for humans, 5 for animals, 5 for environment. And the reason I sort of wanted that lower number is to make a meaningful difference. We could have 300 charities and send out $10 each, for argument's sake. That's not going to shift the dial much. So I'd rather have a smaller number and make a meaningful difference. So we have charities, some well-known brands. We have Variety, Kids Charity, that's now called. It used to be Variety Club. We have Relied, Habitat for Humanity. And then we've got some lesser ones, which are Food Bank, as I mentioned. Then we have Pet Rescue. We have, on the animal side, we have a horse sanctuary one. On the environment side, we have Carbon Positive Australia, Take 3, which is about ocean and education around plastics. And they're two really good examples about how you can make a meaningful difference with your brokerage. Now, Carbon Positive Australia does reforestation and regeneration of our natural bush right across the bottom and up the eastern seaboard, and $4 plants a tree. So, it doesn't take much from one trade to make a meaningful difference. Take 3 educates kids. They also collect rubbish, but they educate school children about, the dangers of plastics in the ocean. Now, they can educate 2 school children for $9.50. So again, it's an easier way or an easy story to tell when, your brokerage can go to those sort of lower numbers. Food Banks creates a meal for 50 cents, so it's easy to make a meaningful difference with your trading. Some of the bigger ones like cancer research, Pancare, it's research, so that takes a lot of money. But, so we have a lot of charities. Do you want me to list them off?
No, it's okay. We'll put them in the notes. We'll put a full list in the notes.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
So your brokerage fees are quite reasonable. What's the proportion that goes to charity and how much are the brokerage fees?
Yeah, so institutional rates, we're price takers, not price givers. So they tell me what we're going to charge them, which is well and good because they do some big lumpy trades. So that's great.
They are the big end of town for
indeed,
a reason.
Phil. Correct, mate. Retail rates, we start at $9.45, GST inclusive. That's up to $10,000 a trade. 15 to 15, and then it's 0.099% or 99 basis points. And basically what we do, we've got costs, obviously. We have got to pay our broking partner for the actual trading side of it. We pay the ASX fees. So we subtract that and divide it by 2.
So you could easily plant a tree for one trade.
Oh, 100%. 100%. And, I love that story and we've used it again, going back to our social media, someone like, a Picture Partners, big firm, big business consulting accounting firm, has a wealth division. They manage about $5 billion. So it's a big firm, but we can legitimately say they offset their carbon footprint by their trading. So, because every time they trade, we go plant a tree. So, it's a good story.
So one of the first things an investor in the share market has to do is open a brokerage account, which is where you guys come in. Talk us through the process.
Yeah, well, there's another thing that's changed a lot over the years, Phil. That used to be so manual, wet signatures. You had to send all your paperwork in, very, painful.
Oh, I'm old enough to remember.
Yeah, exactly. And you know what? That's still the biggest challenge in our business because, people are inherently don't want to change. I think statistically, you're more likely to get divorced than change your bank account. But the way we do it is a lot better through technology. So it's all online. So you go to the Trade for Good website, www.tradeforgood.com.au, get started across the top menu banner, and then you choose your charity, fill in some details, your electronic verification of yourself. If I use a individual personal investor, retail investor, stick your license in or your passport. It verifies who you are. We automatically open a Macquarie CMA account, and we do that. Well, it doesn't cost you anything, which is a good thing.
That's a cash management account, isn't it? Because you've got a cash account along with your broking account.
Yeah, and we do that because 2 reasons. It reduces our risk, and it also reduces the end investor's risk of fat finger. So we do cash vetting. So, you must have $5,000 in your account to buy $5,000 worth of stock. You accept some T's and C's at the end of that, and then we set you up with our desktop version of our trading and our free mobile app, which you can also trade from, and you're sort of up and running within 24 hours.
Great. So let's go through it. Placing an order, what's the difference between a limit order and a market order?
Yeah, a limit order is as it sounds, right? You dictate what price you are limited to on your buying or your selling. So you say, I will only buy BHP at X price, or I will only sell BHP at X price. A market order is, I just want to buy it, I just want to sell it, and it'll go through at whatever the market is at that particular time.
Are there any dangers in either one of those approaches? Actually, I'll just tell you a personal story, because I do like looking at the depth, the market depth, when you place an order. And you can sort of see, oh, okay, I can kind of see where my order will sit in the market depth. And you might be waiting for a long time for that that order to go through. I'm sure you've seen that many a time.
Yeah, especially on the sell side, right? You always want to sell
when you want
more.
to go. Yeah, that's right. Yeah.
Yeah, no, you're 100% right, Phil. Dangers, look, I guess, again, it comes back to, your personal mindset. Dangers are, I'm going to sell it at market, and then, of course, it goes up 10% further in the day, and you're like, God damn, wish I didn't do that. There's no real inherent danger, I don't think, other than, missing out on the price that you wanted. So
you also provide watch lists. Why are watch lists important?
Yeah, watch lists are great, actually. Within our trading platform, it sort of drives the whole, I guess, functionality of the platform. So you create a watch list. So that allows you to have one simple space that allows you to monitor the stocks that you're interested in. It then drives things like charting, depth, as you mentioned, and the market information fundamentals. And, simply clicking in your watch list on BHP, it then alters the rest of the platform to say charts will update your fundamentals, your depth, etc. So it's a great, easy way to have a snapshot of the stocks you're interested in. From there, you can, right-click trade, buy or sell the stocks that you've got in your watch list. And importantly, you can add alerts. Alerts are a fantastic tool, which allows you to say, well, there's a number of different levels of alerts you can set. You can do it on, price. So tell me when BHP hits a certain level, or if it goes down a certain level. If the bid price or the offer price hits this price movement. So if one of my stocks, if BHP goes up by 10% today, let me know. Volume, if it's doing X amount of volume, or even news, if it comes out with price sensitive news, let me know. So it'll send you an email, or it'll send a direct alert to your phone. So you're always, up to speed with what's going on, unless you're going to sit there and stare at your screen from the hours of, 10 till 4. Or just after 4, it's
not good for your mental health unless you're a professional at it.
No, correct.
Yeah. So you mentioned charts. How would a beginner begin to approach charts? Because they can be very, very complex, can't they? And they can be
100%.
And it's really, you just have no idea about what's going on with a chart when you first look at one. So what would be your suggestion for someone looking at a chart for the first time?
I would ring Ben. he is a chartist expert. Look, I'm a simple line chart sort of a guy. I think the candles, so you can see visually when there's selling pressure, the red candles versus the green, which is the buy. I think that's, I am a simple chartist, Phil, to be honest, but, they sort of visually tell me that you can see pressure if the stock's getting oversold. So obviously the price will come down. But there, again, there's lots of good charting information out there. Google's a wonderful machine. AI is fantastic, ChatGPT. So there's a lot of wealth of information out there. It's, again, about education.
It is, and there's so many different styles of being a chartist as well, isn't there?
Oh, yeah.
Reading candles or reading patterns or looking at momentum or, the indicators, whether you're a MACD kind of person or a...
There's everything.
There's so many of them. So, approach it carefully, I would suggest.
Yes, correct. Because, it is a good tool to, I guess, figure out momentum, and certainly goes back to, your understanding the business. Charting's a good way to go back and look at price history. What's this stock done over the last 5 years, 10 years, 1 month, 2 weeks? Does it have seasonal increases or decreases?
I think it's also worthwhile because there's also the trap of catching a falling knife. And I think just by looking at a chart for a company over a long period of time, it gives you just a bit better idea, because people go, oh, look at it, it's at $5 today. It must be really cheap. But then if you look at it in context of that price action over a period of time, you can say, well, they can go a lot cheaper as well.
Yeah, 100%. 100%.
Yeah.
Very good tool though, charting, and as you said, there's people out there who call themselves chartists and they just love a chart. And as you said, there's indicators. Oh my God, there's hundreds of them moving crossover averages and blah, blah, blah.
The golden cross, the death cross, all that sort of stuff, And then you get into the candles as well, all the different kinds of candles, We'll get back to the show right after this brief message. Why am I buying, holding, or selling a share? If you can't answer that basic question, then you don't have a plan. The best investors are ruthless in executing their plans. I've been fortunate to meet many great investors on the podcast. Tony Kynaston is one of the best. He has a clear and systematic approach to investing that is honest, sensible, and methodical. It's called QAV, Quality at Value. QAV now offer an excellent light plan for only $29 per month. You can follow their buy and sell recommendations and learn the ropes. And the first month is free using the promo code SFBLIGHT. Go to qavpodcast.com.au to sign up. That's qavpodcast.com.au using the promo code SFBLIGHT. Past performance is not a guarantee of future returns. Please read the QAV FSG and consult a financial professional before investing. I receive a small commission for services I recommend, and I only recommend services I use myself. I'm referring now to a recent tweet that I saw you guys were on X. I don't know what you're supposed to call it anymore. About many brokerage services not charging brokerage anymore, especially in the US. Tell us about that. Talk to us about what's going on there.
Yeah, look, it's interesting. That will never happen in Australia. I don't think it's not legal here. ASIC don't allow. What they do in the US, it's called payment for order flow. So, Robinhood is obviously the biggest name around doing that sort of thing. So they get paid to put your orders somewhere, usually with a market maker or another broker. So they get paid, and that's how they make money. So they can charge you no brokerage. And look, Robinhood's a good example. They don't charge brokerage, but they make $1 billion out of order flow. So they get paid that way. US is a total different market to us. But purely based on volume as well. I think I read during the pandemic, I think it was TD Ameritrade, one of the big brokers, might have been Charles Schwab. In one day, pure retail did 7.3 million trades. Now, our market wouldn't do that totally in, months. Not months. That's an over-exaggeration. A month. So
we're tiny, let's face it.
Yeah. Correct. So they get paid for that. They also do, in the US, they have sort of a default margin facility. So if I bought $10,000 worth of shares and didn't pay for it, well, it rolls automatically into a margin type facility. So then they start charging you interest. So they make money that way. They make money out of stock loan. So we're talking about shorting before. That's quite a big strategy in America, and they make quite a lot of money out of that. So, pay for order flow is the main reason. That's why they can charge no brokerage. As I said, I don't think that'll ever come in here because that's, it's not, ASIC don't like it. I'm not 100% sure if it's legal or illegal, but certainly ASIC do not like it. So I don't think it'll ever come in here.
So it's these market makers just shaving off fractions of a cent on each particular trade over many, many trades, isn't it? That's how it works. Yeah.
Yeah, correct. There's some clever, again, comes back to technology, but, there's clever things like, they can do pre-match books. So, if you're a broker and you're charging brokerage, certainly at an institutional level, you're always trying to do a crossing, which is to find a buyer and a seller, because you get two legs of brokerage. You get on the sell side and the buy side. So, if they get all this order flow and put it into their pre-match book, they get more chance of crossing things up, which obviously good revenue, two sides. But they also put it into their black box, algo, secret sort of technology trading stuff that they, as you said, shave a point either side and make money out of it.
Wow, it's fascinating the way it works, isn't it? We feel so. It's a little bit old school and old fashioned here in Australia, but it's quite a solid regulatory framework that we operate in, isn't it?
100%. Especially in the region. That's why we attract so many international investors, I guess, is because of our regulatory framework, certainly, especially in the region. We are seen as one of the safest markets to invest in.
Do you have any horror stories of full service brokers? There's a question without notice for you.
Yeah, horror stories. Well, I think the biggest failure, I guess, we've seen in my time has been, poor old Macintosh did back in the day. As I said, we were probably one of the most predominant brokers in Australia, probably along in Melbourne, certainly with Potter Partners, which obviously became Bell Financial Group. We were at some point, I can't remember it was in the early 90s, I think, one of the corporate guys decided it was a great idea to float the Grand Hyatt, and they underwrote it, which means if you say you're listing a company at $30 million and you underwrite it, you guarantee to the company that you'll pay that $30 million. Now, normally if it's a good placement or an IPO, you spread that risk because you're confident it'll get away and the investors will take it all. If there's a small shortfall, say $1 million, well, you've got to pay it up. Unfortunately, they didn't get it away, and that was a direct result, was that Macintosh then had to find a buyer because it couldn't find the $30 million. And that's how Merrill Lynch came to Australia. They came in, bought the whole Macintosh business for a very, very cheap price, and Macintosh was unfortunately gone forever, and it became Merrill Lynch. Because
brokerage firms aren't just about buying and selling. They do other things. They get involved in
corporate.
Yeah, they get involved in things like corporates and IPOs, don't they? Yeah.
Yeah, definitely. I mean, corporate is a strong, if you're a full service broker like a Bell Potter or a Shaw's, that's a strong level of revenue, because when you do a listing or a placement or help companies raise money, you can charge bigger fees, and that usually is somewhere between 2 to 6%. Harder stocks to get away, probably you might get a little bit more than that. Whereas your average brokerage account, you can't charge someone 6% to, buy or sell a share. It's down in the basis points level these days. So it's a big revenue line for most full service brokers. You have research departments for the bigger institutional brokers. That's another big department, because they're always trying to find the edge on a particular stock, and research through the fundamentals, through the financials is a good way of doing that. And then, of course, you go then sell it to your institutional clients. Hey, Phil, ABC, big shop financial planner, I've got this, tip on this stock. Not a tip. I've got this fundamental data. Our research suggests this is a great buy. And that's how you sort of drive revenue through those research ideas.
So how can listeners find out more about Trade for Good, Al?
Easy, Phil. Easy. Follow us on all our socials, as I said. But the easiest way is www.tradeforgood.com.au. All our contact details are there. We're always happy to have a chat to anybody. Account opening there. Information about all our charities are there. Pricing, etc. That's the easiest way. And as I said, we'd love to chat to anyone who wants interested in opening an account or just wants to find out more about the charities that we support.
Okay, well, we'll put all of those links in the blog post and the episode notes as well. So, Al Warren, thank you very much for joining me today.
No, Phil, thank you. We had a couple of false starts with missed planes, etc., but thank you so much for having me. It's been an absolute pleasure.
Oh, it's always good to get the technical issues out of the way and then have a trouble-free interview.
Thanks, mate.
Okay, mate.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.